I want to discuss with you today what happened to us in mid-December 2014. I remember that was we lived through quite a historical event. When our currency just sort of collapsed very quickly, and then also very quickly recovered. This is one of the contracts in our national currency. These are spot contracts. Do you know a bit how currency markets work? Like, what is a spot contract? Spot contract is a contract that gives you the right. If you enter a spot contract, basically you can buy or sell at a fixed price currency. Yes, for example, US dollars. If it's US dollars ruble spot contract, then as its price is, for example, 60 rubles, then it gives you the right to buy currency $1 at the price of 60 rubles, for example. So spot contracts can be quite different. So this can be spot contracts with delivery today, meaning that sellers will have to sell dollars at this particular fixed price, for example, today, or tomorrow. This is like spot contract for tomorrow, with delivery tomorrow. And there can be also spot contract with delivery in 2 days after the contract was signed. So this one, I think, is the most, if I remember correctly, maybe it's actually the picture for the whole spot market, where in the red is sort of the spot rate, the exchange rate, which you can get from those contracts. December 11th, it's sort of a special day. We'll talk a bit about it. Also, December 12th, that's Friday. This is December 15th, 16th, and up to December 19th. So the red is basically the exchange rate. And the exchange rate was going up actually since July 2014, because since July 2014 we had many things happening in our economy. The most important one was probably the collapse of oil prices that started to happen in July 2014. If you remember, since that time, basically the price of oil just have been going down, and of course it had huge effect on our exchange rate. So since July, the exchange rate was going up, and of course there were some sanctions also, and a lot of other things. But the background for this event was sort of quite fast depreciation of our currency since July. And you can sort of see this trend. It's just sort of a little tail from that trend. But then suddenly something really strange happened here. And let me just tell you that this in blue, this is I have here the volume traded in those contracts. I think it's the aggregated volume, if I remember correctly, for all of those spot contracts for today, tomorrow, and spot. So this is sort of how much has been executed. I believe this is probably aggregated for each 5-minute interval. So for each 5-minute interval, there is some bar. So you can also see that how the volume has been changing within each calendar day. So anyway, suddenly, basically on December 15th, the exchange rate that used to be about 58 rubles per dollar suddenly started to go up. That was Monday, December 15th. Then, if you remember, do you remember much of what has happened? Do you remember what the central bank did at that time?
Raise interest.
Yeah, so that's this the exchange rate going down. This is exactly at night. The central bank raised interest rates by like 6%, 6-7%. And of course, that had effect on the exchange rate. So the exchange rate for US dollars will go down. Yeah. So the exchange rate went back to 60. This is the beginning of 2000 December 16th. Because presumably when the exchange rate, when the interest rate goes up, what happens? Why the exchange rate should go down? Next day, something even worse happened because ruble started to depreciate even more very quickly, and the exchange rate. This is in dollar. This is for dollars. So the exchange rate for dollars hit 80 rubles per dollar. This was that peak. It happened at around 3 p.m. I believe, and then afterwards. This is sort of a 5-minute peak because I told you that all of the data here is aggregated for 5 minutes. So you can see that the peak was just sort of almost like 1 point on this chart, and then it sort of started to drop down. And for the whole day on 16th, it was sort of going down in some sense. And this is when I was preparing the exam. Here. And then the exam was here on December 17th, for those who remember. So the exchange rate didn't go down all the way, but I was sort of shaken after the exam also what has happened to the exchange rate. Because one of the questions, I think, in the exam was what will happen to the exchange rate. And so it actually went down by December 17th. And then it sort of stayed there. So the question is, what has actually happened? Why, our currency depreciated pretty much by 40% so quickly within just a few hours, pretty much, and then it went down, went back to the normal. So it was quite interesting to read people who panicked and who have been talking about this. Have been depicting these apocalyptic pictures of how bad is everything, and that we are going through, that is very similar to the default of 1998, and our economy will collapse, and there will be default, and like some horrible pictures. And for me, it was sort of clear that it's sort of wrong to compare these two crises, because there are basically, sort of broadly speaking, there are two types of crisis. One type is very important macro crisis when maybe there will be banking crisis, maybe there will be some defaults, soaring defaults, and bouts of inflation, and a lot of horrible things. This is what we saw pretty much in 1998, and this is a type of crisis that happened in 2008, the financial crisis that we're sort of still not completely recovered from. So these are huge macroeconomic events. They're usually very, very complicated. They require sort of structural changes in the economy, and usually they happened over a long time. So usually it will be like years to recover from those crises, to go from this. So this is what I would call macroeconomic crisis, and of course within those crises there can be different varieties also of crisis. If you're interested in those crises, you can just read the book of Reinhardt and Rogoff. That's sort of the famous book about the collection of all these different hundreds of different crises that happened in history. But there's another type of crisis that will be more like market microstructure crisis. These are more technical events. They are usually short-lived if followed by appropriate government policy. And I would say that the December crisis in the currency market was of that sort. So usually, this technical crisis are usually caused by some technical things, like usually it can be some large order, for example, or the collection of orders executed somewhat quickly in the market. And so those orders that hit the market, the market sort of is not able to digest them, so they're executed sort of faster than the normal speed with which the market operates, and this creates a collapse in prices. Usually, however, these events are short-lived. They may take maybe minutes or days or months, but they're not structural. Basically, if you look at also what has been written in the press, there was some other event that I didn't discuss with you that happened on December 11th. So on December 11th, one of our oil exporters, Rosneft, issued bonds, ruble-denominated bonds, for about 625 billion ruble. Those bonds have been issued on December 11th, but those rubles had to be somehow exchanged into dollars, because the company would need dollars, not rubles, by Sunday. And this order could take different forms. It could be executed in a very complicated way through different sort of derivative contracts, and but ultimately, I would say that a huge chunk of what we saw was due to this sort of large order of conversion, one way or another, rubles into dollars that sort of went through our currency trading system and sort of crashed it. I don't think it was so simple in the way that that the company just exchanged those rubles into dollars. So it was probably much more complicated, and that's why it's also difficult to see it in the data. But let's talk actually a bit about what were the options available, how our currency market is structured, because the currency market that we have is quite complicated. As I said, there will be spot contracts. We deliver it today, tomorrow, and spot. Approximately the size of this market is about $10 billion a day. This is how much, this is a dollar volume traded in those markets. The most active one is tomorrow. The figure that shows, also with the exchange rate in red, it shows how much of volume has been executed in the spot contracts. But here it's aggregated daily. So in green, these are this sort of 5 days of interest in December 11th, 12th, and this is Monday, Tuesday, Wednesday. So in some sense, we sort of don't see here large volume. So we don't see here that there was some large order that somehow was executed, because the volume here was sort of similar to the volume that has been executed in those markets before. So this is the spot contracts. Then in addition to this, there are swaps. So for swaps, there are also about $10 billion traded per day. So swaps would be, it's simple. It's a combination of spot and forward. For example, you buy a spot contract and you sell forward. Basically, it's a contract that allow you to, for example, buy currency today at some rate and then sell it at some time in the future at some fixed rate also. So this is swap. You sort of swap currencies from one day to another day. And there are many different types of swaps. So it can be a swap from today to tomorrow. This is, I think, the most actively traded swap. It can be from today to 1 week from now, to 1 month from now, 3 weeks from now, 1 year from now. All types of different swap contracts that help to shift risk exposure between different dates. So as I said, there are about 10 billion in traded there. Corridors also determine how much margins traders have to post into the system. So here you can see that the deviation from blue and those corridors from the exchange rate and those corridors are quite large. So this is sort of the margin of almost 30 rubles, and there it's almost like also 30 or 40 rubles that market participants would have to place into the system, and maybe they will not have so much money on the account, and then they will not be able to make those trades. So anyway, there have been a lot of interesting things happening sort of on the microstructure level there, especially also there have been it's sort of interesting to investigate what has been happening with options, because some of them have been exercised in the money if we're talking about call options, and this could potentially create this very quick spike upward. So I guess my story broadly is that probably this large order came to the market and sort of exhausted all of the liquidity in the market, and then the limit order book here was sort of so thin, pretty much no orders there, that any even sort of small orders would change the price a lot. So this is what we see here during this 5-minute interval. But it's quite interesting to investigate in more detail what has happened, and some of our students actually at MIF program, they will be hopefully they will do some analysis on what has been happening during these hours, and what exactly has been happening with the market liquidity. Okay, so let me. There are a lot of other hypotheses that I think are not that reasonable. Some people would say that it's all about animal spirits, and somehow it's all because of philosophy, some psychology. But I personally don't believe that expectations can move the exchange rate by 40% just in a few hours. So this is something that will be, expectations are important in macroeconomics. Expectations of people are being formed over a course of months and years, but here in market microstructure, everything happens so quickly that it's impossible to imagine it's hard to imagine that all of those expectations just somehow synchronized in a way that moved the exchange rate so much, because even if you know that there'll be some large order to buy dollars, for example, in the market, you don't know how much the price will move. I showed you my formulas, but other people may have different formulas and they'll have different estimates. It's a bit unclear. It will also depend on what will be the strategy that a large trader will be using, and depending on his strategy, price dynamics will be different. It's unclear whether the price change will be permanent or temporary, and so you can have different answers on these questions, and people may have different expectations. So it's hard for me to imagine that this is all just due to expectations. The example that I usually give is that if you think about earthquakes, So earthquakes can destroy buildings, but expectations of earthquakes just cannot destroy buildings. Those huge events should really happen. It cannot be just expectations. Those events have been happening in the past in other markets. If you're interested, I have a paper on this, sort of talking about with the analysis of different crises that happened in the past. So one of them actually happened in 1929 in the US. The market just went down at the end of October, suddenly by 25%, like in a few days. That huge decrease in the market price was also triggered by this huge execution of a huge position. It turned out that in the 20s, a lot of Americans bought. It was very fashionable to buy stocks on margin. So when you buy a stock on margin, it's like you invest maybe 20% of your own money, and you borrow 80% from your broker to buy a stock, and then you use that stock as a collateral. So you keep it at the account of the broker. So if someone, so that he has some sort of safe collateral on the hands. When the market goes down, it's like the value of your collateral goes down. When the value of your collateral goes down, brokers issue margin calls. So investors either have to add more assets, more collateral, or if they cannot do it, then broker basically has to liquidate the collateral. And so, of course, if the broker liquidates the collateral, this pushes the prices down. And this creates sort of this negative feedback loop. Because the price goes down, the value of the collateral is even smaller, and then you have to liquidate more of it, and so on and so forth. So this basically creates this negative dynamics. It's very difficult to get those estimates, but it was approximately $1 billion executed. In those times, it was about sort of 3 times more than the average daily volume executed in those markets, and it was actually 1% of GDP in US at those times. What would be 1% of our GDP now? And you can imagine, how huge that order sort of was. That huge order basically crashed the American market. It started to recover because regulators actually did in the US. They did very good job because they sort of spread that huge order across time. So instead of all those margin accounts being liquidated very, very quickly over the course of a week, basically they sort of allowed to liquidate it very quickly. So, for example, banks raised, sort of loosened their margin requirements. In other years, it slided back again, sort of collapsed. But this was the Great Depression. It has nothing to do with the market crash of 1929. These were completely sort of different events. But it's the example of how, again, sort of large bet maybe here placed not by one market participant, but sort of a bunch of somewhat small market participants could actually crash the system. Another quite famous market crash is the market crash of 1997. Suddenly, the American market just collapsed again in October. It basically collapsed by, over the course of like a few days, by, depending on how you count, by 30% or 40% for futures market. It's still sort of unclear what has happened. People would have different theories. It's quite interesting that usually people continue arguing about what has happened during the crash and why it has happened for basically hundreds of years. So even for 1929, still there are a lot of books written about what has happened, and there are different views. So the one that I talked to you about was more like some of the views that the regulators had at those times, and the view with which I agree. But this crash was also caused by, most likely, caused by a huge bet. It was a bet order executed by portfolio insurers. In one of the big French banks, Société Générale, there was a guy who accumulated a huge fraudulent position. So he just sort of pretended that he didn't have position, sort of sent some fake emails and sort of cracked the system. But this, he accumulated this huge position for like 50 billion euro in European indexes that started to lose money also in the beginning of January 2008. His position started to lose money, and that's when the bank actually figured out, to their own surprise, that they have this gigantic order on the balance. And of course they had to liquidate it because this information was leaked to other market participants. You know, it's not good when other people know that you have a big position that is losing money, because they'll be front running you. So the bank was actually liquidating that position also very quickly, over like 2-3 days maximum. And this created collapse of the market. Most of the European markets just collapsed by 10-15%. And then they sort of started to recover. And then, of course, the financial crisis hit, and all this scandal with the bear storms. This was sort of true event. You know, the crash of January 2008 was just due to that huge order executed in European financial markets that also sort of didn't get. I think they still don't have very good safeguards in the system. And then, of course, it followed by the financial crisis. It was sort of a completely different set of events. It just, they happened to be somewhat close to each other. But I think that for most people, actually, somehow this fact is unknown, and it's not a common knowledge that these large orders create these huge crashes. But they happen, and so it happened to us pretty much. Hopefully, it will not happen again. Here, you know, I'm sort of assuming that this our market crash, our order was $10 billion. Maybe it's too large, probably it's smaller, but you can see in terms of average daily volume and the percent of GDP, it's sort of a huge order. So we basically probably lived with you through the historical events of the order of 1929 and 1987. But it was also similar to the flash crash. That was the order that was executed very quickly and created this temporary impact. So it's actually, if you see that, you know, the impact is temporary, it quickly reverses, then it means that most likely this impact is due to very fast execution. That's sort of the sign that it was something about the speed of with which that order was executed. So I think that's pretty much, that's pretty much everything I want to say. In terms of what to do, in addition to, you know, the safeguards on the system, in general, I think it's important for the exchange and regulators to do more research on what is happening on the exchange, who is trading on the exchange, what are the typical trading patterns, and then to see if something goes wrong, if somebody is suddenly trying to sell a huge amount very quickly, because it can be just a mistake. Yeah, it can be just that somebody added 3 more zeros into to his order. Maybe he wanted to execute 10 million and he executed 10 billion. So absolutely different things may happen. Computers can sort of fell into some infinite loops and start sending orders. Many things may happen. And our systems should be tuned for this, and they should be able to automatically stop somehow those behavioral, maybe kill some of the algorithms, just stop them and ask those traders to figure out what is happening with their computer. But yeah, so I would say that this would be the right lessons to learn from this type of crashes. It's not something fundamental. It's something technical. So it's not that serious anyway.